And today we're going to dive into one of the most misunderstood parts of real estate investing, risk. Understanding the different types of risks involved, understanding how deal structure either aligns or misaligns the different parties in a real estate transaction. Ben and I are going to talk about how risk is not created equal, how we separate systematic risk from idiosyncratic risk, and how we can design deals to make sure that all parties are taking risk appropriately and paid for that risk. Before we get into that, I want to talk about the ethical topic of the day. Ben, can you tell us a little bit about the words here at the top of the slide and how they relate to risk taking and risk alignment?
Absolutely. The rabbis teach us a moment of humility. We all do want to really believe that we have the ownership and control in life. The rabbis teach us that you should not be too confident in yourself until the day you die, meaning there should be no point in your decision making where you believe that you couldn't be wrong about something. When it comes to real estate investing, then there's so much we can't control, and there's so much more that we don't even know that we can control. Now, Moshe, you had mentioned that with your time at Amazon, you had a different phrase. What was that?
Sure. So while I was working at Amazon, all of our decisions were guided by leadership principles. And one of those was that managers shouldn't smell their own perfume. And that applies to managers of tech teams and certainly managers of financial instruments and, in this case, real estate. But the idea is that you shouldn't just rest on your laurel. You should always be checking your work, checking yourself, and being honest with yourself, making sure that all your assumptions are correct, are up to date, and not just letting things pass by without rigor.
Yeah, you're totally right. I mean, we all have that overconfidence bias. We have all these experiences in our life which make us think that we know how the future is going to turn out. But understanding the future is a lot harder in practice, especially the longer you've been around. The more gray hairs you have, the more you realize how important this is to remember. So this is our ethical minute. This is what we have to remember today. Not to be too overly confident in what you know, and have a lot of respect for what you don't know.
It's a great way of putting it. Let's jump into that because there are things that we control and things that we can't. So I'd like to frame the discussion. Systematic risk are things that affect the market as a whole, generally thought of as things that we don't really have much control over. Idiosyncratic risk is the risks that are specific to a deal, and then the structural implications is what we're really going to dive into. And that's how we balance those two risks between the sponsor and the LPs when it comes to real estate. Ben, can you tell us a little bit more about some of the differences between systematic and idiosyncratic risk?
Yeah, absolutely. You're going to jump into the next slide.
Sure.
So systematic risks are risks that are part of the market. They're essential to the market. In other words, we don't know what the future is going to hold. We don't know if the Fed is going to raise interest rates next quarter, or they're going to stay the same, or they're going to go down. All we know is that interest rates are variable. And especially in real estate development, no one's giving us fixed rates on our projects. That has a significant impact. Capital markets, we may start a project today and think that the project makes sense as long as we sell it within 5 years, but we get 5 years from now and debt or equity is just not available. Debt or equity doesn't become available for 7 years. Understanding how capital markets vary is important. It's important to consider. It's a systematic risk of our project. We don't know how we're going to consider it. All we know is that it's a variable out there and something we have to be very respectful for. Same goes with regulatory shifts. There's all sorts of things that can change over the course of any given project, whether it's tax rates or new zoning rules or rent control goes into effect. All these things are things we just can't control, as we've just seen. New York City appears to be going through or heading towards a major shift in regulation. And or if you're one of those people who's in the middle of a real estate development there right now, it's adding a lot of uncertainty to what your forecast is. We also have market cycles. We have sub-market trends, local supply and demand dynamics. These are all systematic risks. These are market risks, things that every single player in your market is dealing with the same risks. It puts us all on equal footing. Moshe, you wouldn't be better necessarily at running a deal with these changes than I would be. The risks that affect all of us relatively equally. Although there are ways that these risks can be managed, and we'll talk about those in some of these later slides.
Absolutely. I appreciate the vote of confidence there, but I do want to shift things back to you and discuss some of the things that we have some control over. And I think those we call idiosyncratic risks. Ben, can you tell us a little bit about what those are, why it's highlighted in pink? There are a number of them here. So why don't we jump into the first one? Tell me about sponsor quality.
First off, I want to say I happen to like the purple either. The pink is maybe it's a fuchsia. It's a very nice color, and I think that we should stick with this in the future. But sponsor quality, these are all special. These are all the sorts of risks that every project you're going to bump into these risks, but the person you're investing in will have their, or the team that you invest in will have their own special twist on whether or not these risks are something where they add value or it takes away from what they bring to the table. So, for instance, you go to a sponsor, you want to find out, has he done it before? Has he or she done it before? What have they done over different market cycles are really important. If someone says, my last 3 years, I've done 8 deals and all of the deals have turned out great, but in that last 3 years, all of the 8 deals have been defined by, contracting cap rates and values skyrocketing. It's pretty hard to lose money in those. So it's good that they did great, but what about different market cycles?
We do a lot of development. Can you tell us a little bit more about some of the risks related to development and how the sponsor team can mitigate that?
Yeah, I can give you a quick anecdote. We're working on a project right now, and we're in the middle of the project. And as we're moving soil around, getting the foundations in the ground, the engineer on site who's monitoring the soil quality picks up on his testing that there's a certain amount of a controlled substance on the site. In this case, it's PCBs, something that was very common in transformers all over the place. And the guys pulling the soil off the site to make space for the foundation said, okay, there's PCBs in the soil. We have to treat it as contaminated soil. It's going to be very expensive to get rid of. So how expensive was it going to be? On the order of $100,000, maybe $150,000. It was not a line item that we had on our budget. So all of a sudden, are we losing $150,000? So it happens to be that because of our sponsor team, we had people on our team who have a lot of experience dealing with industrial sites, and they looked at the data and they said, yes, the soil, if it were to be disposed of at a facility, would cost all this money, but the soil can actually be left on site. In fact, once it's removed, you can go ahead and put it right back in after the footings are installed. So go back and put the soil back down under the footings. It's safe. It's not a hazardous material. It would only be hazardous because of its unique attribute to go to another site, but it can go under the slab. It's not going to affect anybody, and it meets all of the state requirements. So that sort of knowledge, that sort of experience, that only comes from having done these things before, created a real value to that sponsor, helping and boosting what the potential returns of the project are going to be.
Yeah, I'm glad I didn't know about that one until now. I don't know if I'd want to look down a $150,000 line item I wasn't expecting. Moving on to the next idiosyncratic risk. Talk to me about tenant and market concentration risk. We have a lot of projects that are ongoing. How do we make sure that we're not oversaturating a market, bringing too many units online?
Yeah, we were really looking at this for some of the projects we were looking at in the self-storage sector. Self-storage is a really unique study in tenant and market concentration because you go to a small town in upstate New York and you want to put in a self-storage facility there. So you say, great, this town has no self-storage. So obviously we're in a great position to give them self-storage, and we should be able to make really good returns on it. The land is cheap, the construction is cheap, it's everything we want. But the risk, if you don't think about it carefully enough, is what if somebody else has the same idea? Or what if somebody else likes your idea so much, another neighbor, that they put in a self-storage down the street? And you quickly not only saturated the market between your two facilities, but you have 50% more storage in that town than the town needs. The reality to self-storage facilities is you build very big facilities. They're going to be 60,000, 70,000 square feet, just big enough that they can actually support a full-time employee. So it has to be good size, and in a small town, you quickly get to that saturation point. You have to really understand what the demands are for your product, what the existing need is, and then you have to think about and predict what's going to happen when other people see your product on the market. Is there a big moat to entry? Is there things that prevent them from coming in and bringing more of that product to the market? Or do you have some sort of defensive strategy in place? that you feel like you can protect. As an investor, these are questions you absolutely have to ask.
Yeah, great point. I think we have a webinar dedicated to this topic, market research and understanding absorption, coming up in a couple of weeks. Moving on to the other point here, financing and capital structure risk, and that's the one that we're gonna sort of pivot off into. We've been creative over this last year in sourcing our capital, and we've had to be careful in how we've layered and structured it. Can you tell us how different types of capital affect deal structure and deals overall, and how introducing certain capital, whether it's too much debt or too much equity, can put a deal at risk?
Yeah, so it's a great point, Moshe. You could have the most beautiful product that you're putting on the market, and if you don't finance it appropriately, you don't set up your capital structure in the right way, you can end up with a deal which maybe you have built something beautiful, but you haven't made any profit on it. Or you can end up losing money on a good deal. So how do you do it? It takes a lot of time to understand the different options in the market because they keep changing. Last year's market is definitely very different than the market today. And 5 years ago, getting equity or getting debt on your projects is very different. So I think in later slides we're going to talk about different types of debt. There's construction loans, there's asset-backed loans, there's all sorts of different ways to get debt. And then we're also going to talk about equity and how equity compares to debt. So equity is going to be we call it a capital stack, where the base of the capital stack is where we put our debt. That should generally be the lowest cost money that we have in our project. And then we pile on top of the debt different types of equity. And the terms of the equity have a really big impact on what the total risk of our returns are for the project. The different types of equity, different equity agreements, and different debt agreements, each of these will give us very different returns in a successful project and in an unsuccessful project. And because we can't control the market risk that we talked about earlier, there's all these things out in the market that we can't control. We have to be very careful about how we structure the financing on all of our projects.
That's a great point. And bringing it back to investors and that relationship between the investor and the GP, one of the things that we can do is try to shift around the systematic and idiosyncratic risk. Ideally we want the sponsor to bear the systematic risk, and we want to protect the investor and expose them to as much or as little idiosyncratic risk as possible. Let's talk about how the sponsor mitigates the idiosyncratic risk, and then we'll get to that other point of how everyone gets paid for bearing different parts of risk in the capital structure. But what is alpha?
Alpha is in finance is the measure that we say that a individual company outperforms the market for that specific company. So if we know that you've got a window cleaning company and you have come up with a way to clean windows faster than all the other window cleaning companies, we say the difference between your performance and other window cleaning companies is your alpha. And I love the fact that you set this up as operator alpha, like it's a superhero. But it's true that whenever you're dealing with a sponsor on a deal, you're expecting them and you're hoping that you're investing in someone who brings alpha to the table. Every project isn't always going to be a perfect project, but if you start with a strong sponsor and it gives you something better, significantly better than what the baseline is, then you have a better chance to succeed. Things like market timing, really understanding local markets specifically can help a tremendous amount to help an individual be a lot better than their competitors. Understanding, for stabilized properties, how to deal with tenants and how to do the right renovations, or even owning, like if you're a buying stabilized properties and trying to get them to have higher returns on investment, having construction knowledge and having the ability to do your own renovations. These are all sorts of alpha things, added value that the operator can bring to the table and really support that thesis that this is going to be a positive project. Ultimately, a good alpha reduces risk and amplifies returns.
Awesome. I think that maybe a similar idea and similar concept, having that development knowledge has been something that we've been able to bring to the table immediately on a lot of the projects. You have a specific story or anecdote and how you brought alpha to a project?
I have a bunch of those projects. I even have one with one of our other sponsors, Ashki. So there's been a bunch of different scenarios where we've been looking at projects and working through projects, trying to come up with the right capital stack. Now, Ashki brings to the table 20 years of banking experience and funding deals. He understands the ins and outs of every sort of deal structure that's there, and he understands the ins and outs of exactly what the investors are looking for. So his insight and his knowledge of the market, and also his knowledge of people within the market, have been able to get us much more positive, much better financing on our projects with the right capital structure than we would have been able to have if he wasn't in the sponsor group. If it were me doing what he was trying to do, there's no way we would have ended up in the same position that we've ended up with. Each of these skill sets creates a team that has a much higher alpha, higher capacity to get things done than a single person on their own, for sure.
Awesome. Okay, so I want to get to the meat and bones of things. There are a lot of terms coming up in the next couple of slides. There are a lot of ways to structure partnerships between sponsors and investors. And one thing that we really focus on at Chestnut River is making sure that their investors are protected, but at the same time, this is a full-time job, and we want to make sure that everyone's getting paid for their work and the risk they're taking. So can you run us through some of these terms? They are lingo of the trade. Explain these for someone who hasn't seen these before and what each of them can mean.
Yeah, so these are really common phrases when you're looking at how an investment is set up. So if you haven't seen these before, this is the great cheat sheet for you. We're going to go through them very quickly, and you just put it in your back pocket so you have it. First off, the most common way of doing any deal, if you're doing a deal with your next door neighbor, is something called a pro rata deal. Pro rata means if I put in 50% and you put in 50%, we both take out our 50% of the profits. And pari passu means we take them out at the same time. In other words, someone gives us a check for $100, we both take $50 on the same day at the same moment. But if I only put in $30 and you put in $70 into that deal, or I put in 30%, you put in 70%, I get $30 out of it, you get $70 out of it, but we both divide up the money at the same time. That's the most normal way of thinking about how an investment goes. You share risk, you share reward equally. The second is something called a preferred return or preferred current yield. If I put in $30 into a deal, we set ahead of time that my money will get back almost an interest rate, or it'll start having some level of return on that money on the capital before any other distributions are done. So that's what it is. So putting in $100 in, it's going to be in there for 2 years. Usually a preferred current yield is calculated as simple interest, although there are a lot of projects where preferred returns can be calculated as accrued interest. The difference being simple interest is I'm putting in $100 based on a preferred current yield of 7%. So then I get back $7 per year. But accrued interest is where it goes 7%. So now the next year, year number 2, I'm making 7% on $107. So it could end up being $8. I don't have the math right in front of me, but something like that. So instead of walking away with $114 after 2 years, it's $115. Sometimes you'll deal with a sponsor who's not putting much, if any, money into the deal. So how do they get money out? The sponsor's in on the deal, right? He goes out and he raises from all of his friends $1,000. And this is an extreme case. He doesn't put any of his own money into the deal. And he says, okay, guys, you give me $1,000. We're going to make back $10,000. If it was a pro rata pari passu arrangement, like in number 1, only people who put money in get money out. So the sponsor makes no money. The sponsor would say, well, why would I do it if I'm not going to make any money? The investors could, at that point, say to him, well, we'll give you a promote. What's the promote? It's going to be 50%. Meaning they take the money that comes off the table, the $1,000, the $10,000 in this case, right? And they divide it 50. First they take their money back. They get their $1,000 back. There's $9,000 left over. 50% of that goes to the sponsor, $4,500. And of the other $4,500, that is what gets split up pro rata amongst the investors. So everyone gets their percentage amount. Well, what if the investors say, we'll do that, but before we do that division, we want to have a preferred return. So the deal is for 1 year. We want a preferred return of 10%. So first they get their $1,000 back. Then they get, or first they get the $100 back. That's the 10% preferred return. Then they get their $1,000 back. Now they have $1,100. There's $8,900 left in the pot. That gets divided up 50-50. 44.50 of it goes over to the sponsor, and the balance gets divided up amongst the investors pro rata pari passu. You see how these stack up? It's confusing, right? When
A little bit.
yeah, no, there's no question. It is confusing. You always want to have a really clean Excel spreadsheet built so you can monitor what every step of these are. Now, the next one down is an interesting rule. It's something called an IRR look back, or an IRR preference, which says basically as follows. No matter what happens before we distribute the money out at the end of the deal, I, the investor, and I say, I'm not going to give you money unless I know at the end of the day that I've made a 12% return on investment, an internal rate of return on my money. So I can put into the deal a rule that says I get a 12% IRR look back payment, meaning you may have distributed money to me over the course of the deal. That whatever money you distributed to me, we're going to calculate that at the time that it was distributed to me. And then at the end of the deal, we're going to say, what was that return on investment of the money you've already given to me? Let's say it was 5% rate of return. Well, I need to get a 12% rate of return. That's our contract. What's the additional amount of money you have to give me to get myself up to a 12% rate of return? That's the IRR look back payment. That's a quick catch-up payment before any other funds are distributed. So it's a great little tool that to keep in your back belt in order to make sure that you have a minimum threshold for what you're collecting before other monies come off the table. Now, as you go through these, each of these get more and more complicated. I don't want to get into all of them, but just so you know, there are ways of structuring these deals. Each one gives you slightly more nuance to it and can help make deals viable that might not otherwise be viable. The number one thing when we're looking at deals as an investor is you don't want to lose money, right? Sometimes it's okay if you don't make a ton of money on a project, but you have to know that you can get out of the project without losing your capital invested, and you want to try to get a minimum amount of return that you feel is fair to justify the use of your capital over this project. The upside, that whatever that minimum amount is going to be controlled by what your potential upside is. If you can make a lot of money on a deal, so your minimum amount should be pretty low. But if you're making a pretty average amount, then you want to have a higher upside, right? It's a risk-return balance. We dig into these in a little bit more. Okay, so the simpler one, like you're doing with your buddies, this pro rata pari passu, that does not protect you, right? That's why it's a big red dot here. If your buddy is the builder and you're the one giving him all the money, and you say, look, he says, well, I'll $500, you put in $500, and then we'll split the profits also. You have to be like, this is crazy. Yes, you're putting money in, okay, and we're sharing on the risk, but you're also the person who's in charge of all the idiosyncratic risk. You're the person who makes the decisions is the one who's ultimately responsible for that idiosyncratic risk. Whether or not you bring alpha to the table is a big factor in how much risk and who's taking what risk. If you're the opposite of the alpha is a negative alpha, and that definitely exists, and there's a lot of bad operators out there. So pro rata pari passu, very high risk unless you really know the sponsor and you know that they're going to do a good job, in which case, all right, so you have more information than your average investor, and it may be totally acceptable for you to work on a pro rata project. So preferred current yield is one way. It tells the GP, the person who's supposed to be bringing the alpha to the table, that, hey, listen, even if you don't perform well, I'm getting my money back, at least a minimum amount of it, plus a basic return. With each case, you can add to it levels of sophistication. The preferred yield with a promote that gives you the preferred yield and it gives you more upside. That's very exciting. IRR look back payment, I went into that in some detail. That's when you set a base rate, but you're only asking for it at the end of the project. And the reason why that's useful to the sponsor is that he needs money, especially for operating a apartment complex. You want to have access to that capital to do everything you have to do when you're running your project. The investor, if they don't need that money then, they're willing to wait till the end of it, just wants to know that they're getting the sort of returns that they're expecting. So that the GP has the risk, but you've aligned your cash flow with the deal's cash flow. There's an IRR preference payment. That's where the LPs have to hit that IRR hurdle before the sponsor gets the return. And then we go into all sorts of different waterfalls as you have preferred returns and profit sharings and 2-tier, 4-tier waterfalls. So we're going to skip them over for right now.
We've discussed a number of things here. We are nearing the end of the presentation portion. Do you want to summarize?
Key questions. These are the questions that we want to ask when we're looking at any project. Number one, it's a risk question. How do we manage both the idiosyncratic risk, which is the project-specific risk? How do we weigh that in with the systematic risk, the market-wide risks? I'll give you an example. Someone comes to you and says, I've got this great 2-family house down the road. We can buy it today and we can renovate it and we can sell it. I've been doing this the last 10 years. And every project I've been able to get my investors at least 15% return on their money, right? You think to yourself, great, I've got a guy who knows what he's doing and he knows how to do it and he knows the market. All these things are really great. These are all idiosyncratic variables that are under control. But at the same time, you also know that if we start this project today, it's going to be finished and coincide with the completion of a 1,000 unit condo complex right down the street. They're all going to hit the market at the same time. And you think, I wonder what would happen in that scenario. Would he actually be able to sell this 2-family home, these 2 condos, for what he thinks he's going to be able to sell it? Or is the competition on the market, is the developer who's doing that big condo project going to be incentivized to drop his pricing enough to be able to steal the buyers from us, from this project? So there's that. Or you think, yes, it may have worked in the last 10 years. Last 10 years, interest rates were at 3%, and now they're at 9%, and maybe the deal doesn't underwrite at 9%, or they're going to be going up even higher. There's all sorts of ways to consider the market-wide risk in reference to that property-specific risk, and you need to think about both of them before embarking on any investment. However, you can shift some of this risk. So this is number 2. How do waterfall structures shift the risk between the LPs? And the answer to that is incredibly significantly. There are a lot of very, very intelligent people out there who can make money on deals where everybody else loses money. And you think, if there's a deal where everyone's losing money, how do they manage to make money on that same deal? And the answer is by setting up a waterfall so that way they get their money off the table before other people. The order of the way the money comes off the table has a huge impact on what your risk is on any project. And the earlier you can get your money off the table, the higher up in the waterfall that your money comes off the table, the safer your money is. Lastly, identifying alpha. A person or a sponsor who is an excellent sponsor should be modest enough to know what types of projects they actually bring alpha to and what types of projects they don't. There's a lot of different projects out there, and every market, every micro market, or every asset class has its own unknowns. You have to really be modest about this and comfortable that when you're walking into a project, if you're the sponsor, that you're really generating alpha for the project. And that requires a lot of research, a lot of timing, and you have to have a really strong business model. You have to really be able to convince yourself that you can make this project more profitable than you can do, maybe not necessarily more profitable than the next guy, but the way you're approaching this project brings your skills and your unique traits and attributes, your alpha, right to the investor. So if you don't add alpha, you probably shouldn't be in the deal.
All right. Well, Ben, thank you. That was quite an informative session. I think it's really crucial to understand that the relationship between risk, deal structure, and protection, understanding different types of risks and what can be mitigated and what investors and sponsors should be looking for, whether it's investing in deals or jumping and pulling the trigger on a specific deal.
Last thoughts on this. What I would say is to anyone who's listening is there's some very good experts out there really willing to teach people how to understand risk. And my favorite expert to listen to, I listen to him every time I can hear him, is a guy, Howard Marks from Oak Tree Capital. He has such an unbelievable way of teaching important concepts and understanding the world as it is today and explaining how different asset classes shift and move get on, listen to his podcast, read his books. Really, really amazing person to learn from.
I love listening to his podcast. I'll go on a walk, I'll be on a drive, and he is very insightful.
Yeah. And through it all, through everything we do here, one of the things that Howard says a lot in his, but that we stress is the reason we have that ethical moment in the beginning is that you have to have strong ethics throughout all of this. When you're working with other people's money, there's so much which is left that people don't have a chance to see what you're doing behind the scenes. But you have to really work on both your own ethics and force yourself to work only with other people who have high ethical caliber standard. I think it's intrinsic to success for your investors.
Absolutely. Well, thank you for taking the time to present this today. If you're still listening or have made it to this point, thank you for joining in. Next week, we will be presenting on returns, K1s, and taxes. So stay tuned for more information on that. Thank you again for your time and looking forward to seeing you on another episode of Real Estate Shark Tank.